Okay. So like I was saying, these are the scope that we are going to be taking for this diet. The first item, there are three segments to this course allocation. We have a self-study, then the allocation to Mr. Shiwaju, then allocation to Adejuwon, myself, and it is expected that for the self-study, you are the one that will study those one on your own. You read them because they are purely theoretical. Introduction to strategic financial management, ethical issue in performance management, okay, performance and management system, all the IT aspect of the syllabus. It's expected that you read them through. It can't take you more than spend like 3 hours or thereabouts. You are done with all of them. So maximum a day, for example. So you are good to go with those one. And when you are reading them, you have to form your note so that you don't go back to that same material that we have used to study. So once you are reading them, ensure you understand each of them. So anyone you have studied or you have read, make sure that you write it down in your own using your own handwriting. Write it down somewhere. So you jot it down in summary so that going forward, it is that summary that you have jotted down, you'll be referencing. So you don't need to go back to the textbook or all the materials that you have researched. Okay, so that is as per self-study. The other part of the syllabus is the one that Mr. Ashiwaju will take you. Of course, when it comes tomorrow, yes, when it comes tomorrow, it will be taking you, it will explain all those items. I don't want to go into that. So it will be doing so that there is no duplication of effort. Let me go straight to my areas of the syllabus. Okay, so when you look at the third part of this table, you will see the allocation to Adejuwon, that is myself. So for this diet, I will be taking you relevant costs for decision making. Okay, I'll be taking relevant costs for decision making. I will also take you short-term decisions. Okay, it is my part of my scope to take you the optimal product mix decision. I will also take you linear programming. We are going to do cost volume profit analysis. We are going to treat in the class marginal and absorption costing. Then we are going to discuss working capital management, learning and experience curve theory, so asset replacement decision, risk, uncertainty, and decision-making under uncertainty. Then finally, we are going to discuss capital budgeting decision. That is not the order in which we are going to take our class. So my first class with you will be operating statements, because operating statement is very fundamental to some of the things to other topics in performance management, especially when it has to do with decision making. Anything that has to do with decision making, you need the technique or the concept of marginal costing. Okay, so if that is the case, let's start from I would have loved to run you through each of them, what each of them entails, but I don't want to, because this is online, we don't have luxury of time, and I want to maximize the allocated time with you. So this evening, I will be starting with operating statement. I will be starting with operating statement. So for those of you that are coming from foundation level, please, I need you to adopt. Just assume that you have zero knowledge of operating statement, even though it's something you have done in the past. Okay, just assume that you have zero knowledge. So I believe, and I know for certain, you are going to learn new thing this afternoon. So let me stop sharing this so that we can move to the main worksheet or the class notes. All right. So let me know if you have any question for me. Just feel free to ask me. Ozioma, good afternoon. How are you today? Muhibat, Abdusalam, Riwan, Sanya, all of you, you are welcome.
Yeah, good afternoon, sir.
Good afternoon.
Good afternoon,
Yes.
sir.
Good afternoon, Muhibat. All right, let me share. Yes, Ozzy, how is my baby?
Fine, sir. Good evening, sir.
Good. My regards to him. Yeah.
All right. Yes.
Okay. So, as a rule for the class, please always ensure that you mute yourself. If you want to ask a question, you raise your hand, then I will attend to you. Please, it's very important so that we don't distract the flow of the class. All right. So let me share the material we are going to be using. And I want to believe you have the material at your disposal. I shared it earlier today. Okay. So like I said, the first topic I will be taking you will be operating statements, because this topic is related to relevant cost for decision making. It's related to optimal product mix. It's related to linear programming. It's related to CVP analysis, cost volume profit analysis, and some other topics like that, including short-term decisions. So there's virtually nothing you want to do, even modern techniques in performance management. So operating statement is related to most of them. So and that is why it is important for us to start with this one. Therefore, what do you understand by operating statement? What is operating statement? When you talk about operating, in profit or loss accounts, we said that profit or loss account is a measure of financial performance, isn't it? That is, when you look at your profit or loss account, the bottom line that you have there is your net profit or loss. That net profit or loss is a measurement of performance. So when you talk about operating statements, just like you have your profit or loss accounts, the income statement measures the same thing. Therefore, it is safe to say that operating statements is a statement that is used to present the operating performance or result of an organization for a specified period of time. All right. It could be monthly, it could be quarterly, it could be biannually, it could be yearly. So it depends on how the question is being structured. But what is important is that we use operating statement to present operating performance of an organization. Generally, there are two methods of presenting operating statements, including the marginal costing concept, then two, the absorption costing concept. Okay, number one method is marginal costing concept, then two, absorption costing concept. So let's talk about marginal costing. Within the next few minutes, 20 minutes or thereabout, we are going to be speaking about marginal costing approach. So what do you understand? Please, if I'm too fast, let me know. For some of you, you may want to join down some notes. But again, if I'm too fast, call my attention to it so that because I don't know how you feel over there, I can't read you. I can't read your mood. So if I'm too fast, please let me know on time. Okay, then. Yes. What do you understand by marginal costing approach? Marginal costing approach is a technique that charges the total variable cost, including direct material, direct labor, direct expenses, and variable overhead to the unit cost of a product. When you want to determine the unit cost of a product, let's say, for example, there's a marker. I'm seeing myself, I'm standing in front of you, and I'm using marker to write on the board. So when the marker I'm holding is a product, is a final product. Therefore, if I want to determine how much it costs me as a company to produce that marker, that is what it's called unit cost. So if I want to determine the unit cost of that marker, that is cost per that product, if I want to determine it, then using marginal costing approach, I will only charge all the costs that are directly related or that are variable or that are directly attributable to the production of that marker, including the direct material. Okay, you pick direct material, you add it, direct labor, direct expenses, and variable overhead. Those are the 4 line items that will go into the determination of a production cost of the marker. So whenever you want to determine production cost of a product using marginal costing approach, you only charge all the variable cost of production. Thought I've switched off this. Oh, because it's my WhatsApp on. Okay, sorry about that. Yes. So I will only charge only the variable cost of production to the unit cost of a product. So that is what marginal costing approach is all about. And it is an accounting system whereby the period cost or the fixed cost incurred are written off fully from the aggregate contribution, meaning that as far as marginal costing concept is concerned, the period cost or other fixed costs should be deducted from aggregate contribution, meaning that the fixed production overhead will not be part of the unit cost of the product. So that's the introduction as far as marginal costing concept is concerned. And again, you need to understand one important key feature of marginal costing concept. The marginal costing approach is a technique designed principally to aid managerial decision. So when it has to do with decision making, you need the knowledge of marginal costing. Okay, you need the knowledge of without marginal costing, you just be charging unnecessary costs into the unit cost of a product, and which may make the product to be unnecessarily costly. Okay. But if you are using marginal costing concept or technique, then it will help you. It will enhance the decision making, managerial. It will enhance managerial decision. That is the essence of marginal costing for decision making. Okay. So now, what are the key points or features of marginal costing that you must take into consideration whenever you want to prepare marginal costing? You want to prepare operating statement using marginal costing approach? There are some key features you must take into consideration, about 4 or 5 of them. I will mention it to you so that when you are preparing your statements, you take them into consideration. Number 1 is that opening and closing stocks are valued at total variable cost per unit. I repeat, using marginal costing approach, opening and closing stocks are valued at the total variable cost per unit. What do I mean by total variable cost per unit? When you want to value your opening stock or closing stock, you go to the question, you pick direct material. Let's say, for example, direct material is 5 naira per unit. You also have direct labor. Say direct labor is 3 naira. You go back to the question, are you given direct expenses? If you have it, put it there. Direct expenses. Say, for example, is 2 naira. You also need to check if you are given variable production overhead. So variable production overhead per unit, say, for example, is 4 naira. Therefore, when I want to value my opening stock, I will add up all the variable costs, all the marginal costs, I will add them together. That will form, when you add all of this, excuse me, this is hanging. Hold on. Let me see. Oh, okay, it's back. Sorry about that. Okay. So this is 14 naira. This represents total variable cost per unit. Okay, so if I want to value my opening stock, I will go to the question, am I given opening stock in units? If you have opening stock in units, say, for example, opening stock in units is 1,000. So we are given 1,000 units as opening stock. So for me to be able to value this, all I need to do is to go and determine my total variable cost per unit. I will add up the direct material, direct labor, direct expenses. and variable overhead. If all of them are present, then that is 14. I would then say 1,000 units multiplied by 14 naira. Whatever I have is the value of my opening stock that I will come and put here. So that is why we are saying that using marginal costing approach, opening and closing stocks are valued at total variable cost per unit. I want to believe that is clear. Now, the second point you need to take into consideration using marginal costing approach is that fixed production overhead is not part of production cost. Okay, I repeat, using marginal costing approach, fixed production overhead is not part of production cost. Rather, it is written off fully from the aggregate contribution. So you don't charge fixed production overhead to the unit cost of a product. When you want to determine the production cost using marginal costing approach, please, you don't include fixed production overhead. Rather, it should be deducted from the aggregate contribution. Okay, good. Then number 3, fixed production overhead is based on budgeted output. Or you can say that the fixed production overhead, using marginal costing approach, the fixed production overhead is a cost that has no sympathy for activity level, meaning that it will not change. It will remain constant for the foreseeable future, for the periods under consideration. Year 1, year 2, year 3, your fixed production overhead will remain constant. It will not change because it is based on the budgeted output. I repeat, using marginal costing approach, the fixed production overhead is constant because it is based on the budgeted output and not on actual units produced. Okay, and that is why it is constant, except that if your budgeted output increases, then your fixed production overhead will change, will also increase. Because, like I said, using marginal costing approach, fixed production overhead does not change. So please, that is very important. It's very important that you get it right. So this is what I'm trying to say. When you look at this, I will still explain this format. I just want to bring to your attention to it. When you look at the period cost, when I was explaining marginal costing concept, I mentioned to you that marginal costing concept is an accounting system whereby the period cost or the fixed cost incurred are written off fully from the aggregate contribution. This is the contribution you are seeing here. This is the period cost you are seeing here. The total period cost is what you have here, okay? That's what you have there. So it's written off. When you say something is written off, that you are deducting it from that thing. So you are expected to deduct the period cost from the contribution, from the aggregate contribution. When you say aggregate contribution, we simply mean total contribution, okay? So this is the period cost I'm talking about. This guy here is the period cost. Sorry, is the fixed production overhead. So this fixed production overhead, you can see, we are not charging it as part of production. Look at the production cost here. So you can see there's nothing like fixed production overhead here. So using marginal costing approach, the fixed production overhead is based on budgeted output. So it will not change, it will remain constant for the period under consideration. How do you then determine your fixed production overhead? Very simple. Just multiply the budgeted output with the fixed overhead absorption rate. Go to the question, go and pick the budgeted output. Say, for example, you are given a budgeted output. I said the fixed production overhead equal to, let me find a bigger space. Let's see. Okay, let me just use here. Now, I said the fixed production overhead, fixed production overhead is calculated as budgeted output. Okay, budgeted output multiplied by the fixed overhead absorption rate. The fixed overhead absorption rate is the fixed cost per unit, okay? fixed overhead absorption rate is the fixed cost per unit. So when you are preparing your income statement using marginal costing approach, for you to get your fixed production overhead, you need to multiply the budgeted unit or normal capacity with the fixed overhead absorption rate, that is fixed cost per unit. Once that is done, then you come and post it there. So that's what you need to do. Then number 3 points you need to take into consideration, number 3 or number 4 that you need to take into consideration is that the marginal costing approach does not consider overhead absorption. Okay, marginal costing approach does not consider overhead absorption. I'm going to discuss overhead absorption with you very soon, but just note that when you are preparing your income statement using marginal costing approach, overhead absorption is ignored, it's not considered. Okay, under or over absorption is not considered. You ignore it. Again, number 5, using marginal costing approach, the marginal costing approach considers gross profits. Okay, marginal costing approach considers a contribution, unlike absorption costing approach that uses gross profit. So those are the key points that you need to take into consideration as far as marginal costing concept is concerned. Okay, so you can also read them through here. Okay, you can read them through. These are 3 of them. I gave you 5 now, so you have 3 here as part of it. Okay, then. So the formats, which format, if you want to prepare your income statement using marginal costing approach, this is the formats you can adopt. Okay, the first item in the format is the sales value. You need to determine sales value. How do you get your sales value? Very simple. Go to the question, pick the unit sold. What is the number of units sold? Multiply that with the selling price per unit. Once you have that, you come and post. Okay, you post it there. Then you move to determining the production cost. Now, this is where you have work. You want to determine production cost. Using marginal costing, all those points I was talking about, this is the time for you to apply them. Okay? So, but the first thing you need to do, you need to go to the question and check if you are given opening stock. Say, for example, we are currently in 2025. Say you have opening stock and we have closing stock for the year ended 31st December 2024. So as you are moving to 1st January 2025, the closing stock of 2024 will become opening stock. So that opening stock in units, the rule says that you must value your opening and closing stock at total variable cost per unit using marginal costing approach. So like I demonstrated for you the other time, say for example, this 1,000 units is our opening stock, and we have calculated our total variable cost per unit to be 14 naira. So 1,000 multiplied by 14, whatever you have, you come and post it there. That is how you value your opening and closing stock. Okay. Then the next thing will then be direct material. Direct material per unit will always be given to you. Say, for example, the actual unit produced for this period is 10,000. 10,000 units were produced. Okay, say that the unit produced is 10,000. That's the actual unit. So all I need to do, I will then go to the question, what is direct material per unit? Say, for example, we are still using our hypothetical number, which is direct material is 5 naira. I will then say 5 naira multiplied by 10,000 units. Whatever I have, I will come and post it there. My direct labor, the direct labor cost, I will pick the actual unit produced. I will multiply with 3 naira direct labor. Whatever I have, I will post. I will also go back to the question if I'm given direct expenses. If, say, for example, we have direct expenses as 2 naira, as given in these hypothetical figures, I will use it to multiply the actual unit produced of 10,000. Whatever I have, I will come and put it here. I will go back to the question. In case, if I have variable part of production, variable overhead part of the production. So say we have 4 naira. So that 4 naira multiplied by 10,000 units, then again, I will post it there. This is how you are going to determine your production cost. I believe it is clear. Please, if you have any question, let me know. And if I'm too fast, call my attention so that I can slow down, I can mellow down. The lecture is just starting, okay? All right then. So at this stage, I need to determine the cost of the total goods available. What is the cost of the total goods available for sales? All right. When you add up everything together, the opening stock plus all the direct costs, add them together, that will give you cost of goods available for sales. The total cost of goods available for sales is that. Now, after you have made the sales, it is possible that there are some goods that are unsold, stock, that is the closing stock at the end of the period. Therefore, I need to go and do working for my closing stocks. And then once I'm done with my closing stock in units, then I will multiply with total variable cost per unit to get the value. So, but we are going to discuss closing stock, how to calculate closing stock later on. But for now, let's maintain with the format. So the next thing I'm going to do after cost of goods available for sales is to go and do working for my closing stock. Once I have the closing stock, I will less it from the cost of goods sold. Then for me to have cost of sales. This cost of sales, ordinarily, I'm supposed to deduct it from the sales value for me to get my contribution. But I will not do that because it is possible there are some items, there are some costs that are variable in nature, but not related to production. For example, sales commission. Okay, you can have sales commission. The more sales you make, the more commission the company will incur on that. So as a result, it is variable. But because it is not related to production, then you need to add it to cost of goods sold before you deduct it from the sales value. Therefore, like I said, what are those items that are variable but not related to production? One of them is selling and distribution expenses, okay? Selling and distribution expenses. There is also variable admin expenses. So you can have variable admin expenses. So you add the two of them together with the cost of goods sold. The total is what you have here. That total is what you are going to less. That's what you are going to less from sales value. You less it from the sales value, okay? Whatever you have thereafter will represent the contribution margin. This is the contribution margin. So with this contribution margin, then the next item will be for me to determine the period cost. The period costs are those costs that are fixed in nature for up to a particular period, maybe for it to be fixed for 1 year or for the next 2 years or for the next 3 years. It will not change, it will remain constant. But once the situation changes again, then that cost will increase or decrease depending on the situation. But it is assumed that it will remain constant for the period, within the period under consideration. So when you talk about period costs, there are those costs that are fixed in nature. One of them is fixed production overhead. When I was explaining the concept of marginal costing, so I mentioned to you that the fixed production overhead will be written off from the aggregate contribution. So again, I've already demonstrated that for you. For you to determine your fixed production overhead, just take the budget. This budgeted output will be given to you in the question. If it is not called budgeted output, it could be called normal capacity. Okay, it could be called normal capacity. All right, so all you need to do is to multiply the budgeted output with the fixed overhead absorption rate. Okay, you multiply with the fixed overhead absorption rate. Whatever you have, come and post it there. Then the fixed selling and distribution expenses will also be given to you. Okay, say for example, if you are a sales director, your salary may be, your compensation may be in 2 different folds. It may well be that you have a commission of 5% for every sales you are able to generate for the company. So meaning that the higher the number of sales you are able to make, the more the sales commission that you are going to earn. That is the variable portion of your compensation. The fixed portion is your monthly salary. Every month is the same amount of salary that you are going to earn. That one will not change. So that, and meanwhile, of course, you are a marketing executive of marketing officer or whatever the title that is given to you, provided you are in marketing. So you can see we have both variable as well as a fixed selling and distribution expenses. Whatever the expenses, in as much as it is fixed in nature, come and put it here. We also have fixed admin expenses. Whatever the company incurred, we put it there as fixed admin expenses. Any other fixed costs that will be incurred, okay? Any other fixed costs that will be incurred, all right? So it will come under the period cost. They add everything together. You add everything together, then you less from the contribution. You less it from the contribution. But the difference you have will represent the profit before tax. That is the profit before tax. You then go back to the question, go and find out or go and confirm if you are given the company tax rates. If you are given the company tax rates, then you need to charge tax liability. So what do? You are going to pick the profit before tax that you have computed. You multiply it with the company tax rates. So whatever you have is the tax liability that you are going to pay. The difference between the profit before tax and the income tax represents the operating performance we are talking about, which is net profit or loss, okay? Net profit or loss, that is operating statements using marginal costing approach. Okay, I just explained operating statements using marginal costing approach. Let me know so far if you have any question for me before we move to absorption costing approach. Any questions so far? Okay. Any questions so far? Okay, so if there is no question, let's move on. Let's go to absorption costing method. Let's go to absorption costing method. Okay. Now, when you talk about absorption costing method, it's a concept that charges the total cost of production, including direct material, direct labor, direct expenses, variable production overhead, and fixed production overhead to the unit cost of a product. It is also known as total costing or full costing method. Okay? Absorption costing method is also known as total costing or full costing method. It's a technique that relies heavily on the generally accepted accounting principle, okay, for external reporting purposes. All right, so that is absorption costing. Remember, we said marginal costing, charge total variable cost to the unit cost of a product. But absorption costing, charge total cost, both variable and then fixed production overhead to the unit cost of a product. That is absorption costing. What are the key points you need to take into consideration as far as absorption costing technique is concerned? One key important point that you need to take into consideration is that opening and closing stocks are valued at total cost per unit. You know, the other time we said that under the variable cost, we only consider, let me rewrite it under the, let me look for somewhere to put it. Yes. So when you want to value opening and closing stock using absorption costing method, you consider total cost of production. To determine the total cost of production, I will pick the direct material. Okay, direct material, whatever the amount that it is, I will pick direct labor. I will pick direct expenses, put it there. I will pick variable production overhead, then plus fixed production overhead. So I will have the five, add the five of them together. This will give total cost per unit. So using absorption costing approach, opening and closing stocks are valued at total cost per unit. If, for example, the opening stock given to you is 2,000, so I will just add up all the total costs. I will add them together. I will now multiply with the opening stock in units, and that will give me the value of the opening stock. So the second point that you need to take into consideration is that fixed production overhead is part of production cost. I repeat, fixed production using absorption costing approach, fixed production overhead is part of production cost, and it will vary according to the activity level because it is based on the actual unit produced. Please, you need to know the difference between the two, between the marginal costing approach and absorption costing approach. I mentioned to you earlier on that using fixed production overhead, using marginal costing approach, fixed production overhead is not part of production cost. It is based on the budgeted output and it will remain constant for the foreseeable future or for the period under consideration. However, as far as absorption costing is concerned, fixed production overhead is part of production cost and it will vary depending on the activity level. If the actual unit produce increases, then fixed production overhead will also increase. If your actual unit produce reduces, the fixed production overhead will also reduce. So it will vary according to activity level because it is not based on budgeted output. That is why it varies. The more you produce, the more fixed production overhead that will be incurred and vice versa. Then number 3 point that you need to take into consideration. Fixed production, absorption costing approach considered overhead costing. Okay, absorption costing method considers overhead costing. You want to know whether budgeted overhead and actual overhead are different. If they are different, then that is what is called that is what is called overhead absorption. We are going to get there as we proceed. I will explain to you what is overhead costing. Okay, what is under absorption and over absorption. All of it I will explain as we proceed. But for now, just note that as far as absorption costing is concerned, overhead assumption is considered. Remember, under marginal costing approach, overhead assumption is ignored. Okay, then the last point that you need to take into consideration using absorption costing method is that, of course, under absorption costing method, gross profit is considered, whereas under marginal costing approach, contribution is recognized. So these are the 4 points you need to take into consideration as far as absorption costing approach is concerned. Then the next thing you need to know is the format of presenting the income statement using absorption costing method. Okay. Of course, the same way you calculated the sales value under marginal is the same way you are going to do under absorption. Just multiply the units sold with the selling price per unit, whatever it is, you post it there. Then you now go to determining the production cost. The first item under the production cost is opening stock. I've already explained to you that under absorption costing method, stocks are valued at total cost per unit. It is total cost per unit. So just multiply the opening stock with the total cost per unit, then you come and post it there. Do the same thing as direct material. The same way you calculated your direct material under marginal costing is the same way. Just multiply the material per unit with the number of units produced. You get this. Direct labor cost per unit, multiply with the units produced, put it there. Direct expenses per unit multiplied by unit produced, put it there. Variable production overhead per unit multiplied by unit produced, put it there. Then, in addition to that, remember, fixed production overhead is part of production cost. Therefore, you are going to pick the fixed overhead absorption rate. You pick the fixed overhead absorption rate, that is your fixed cost per unit, you multiply with the actual unit produced. That will give the fixed production overhead. You add up everything together, that will give the cost of goods available for sales. So once you get this cost of goods available for sales, then you need to consider if there are closing stocks. Okay, if there are closing stock in units. So if any, just multiply the closing stock per unit. Okay, multiply the closing stock or the closing stock in units, multiply with the total cost per unit to get this guy. So the closing stock minus cost of goods sold will give us the cost of goods available for sales, will give us cost of sales. So once you have the cost of, immediately after the cost of sales, you need to adjust for overhead absorption. Please take note so that you don't get it wrong. You don't give what belongs to Peter to Paul. So immediately after the cost of goods sold, you need to adjust for overhead absorption. Whether it is overhead is under absorbed or over absorbed, you need to consider that. So if it is under absorbed, of course, you are going to less it from the cost of goods sold. But if it is over absorbed, you are going to add. I will explain to you what under or over absorption is all about. Just hold on first. Let's explain the format first. So after you have made the adjustments, the difference between the two, then you put it here. So this number minus the sales value will give us the gross profits, okay? That will give us the gross profits. Now that you have the gross profit, what is the next thing? Then you need to consider non-production cost. This non-production cost could be variable or fixed. Whatever it is that is non-production cost, just add all of them together, okay? Both variable and fixed non-production costs, add all of them together. So you deduct it from the gross profit. Whatever you have thereafter will represent the profit before tax. Once you have the profit before tax, you need to charge tax. So just multiply the company tax rate with the profit before tax. That will give you the tax liability. Difference between the tax and the profit before tax will give you net profit or loss. Okay, will give you net profit or loss. So that is how to prepare income statements using absorption costing approach. You can see that they are slightly different. Both absorption and marginal costing concepts are slightly different in the way you prepare them. And that is why at all time, whenever you prepare income statement using any of the two methods, they cannot produce the same result. There will always be variance. And that's why examiner will ask you to reconcile the variance, okay? You need to reconcile the variance. So again, you can just read more. I've already explained all of this, all these points. I've explained it earlier. So I gave you 4 points. So you have 3 here. All right then. So let's talk about overhead assumption. Let me see if I have it. It's not here. So let's talk about overhead assumption. Okay, overhead assumption. Okay, overhead assumption costing. What do you understand by overhead assumption costing? The overhead assumption costing is the process of charging indirect cost. That is overheads. When you talk about indirect cost, is the same thing as overheads. So overhead costing is the process of charging indirect cost to a product or service. What are the examples of indirect costs? Costs such as rent, electricity, heat and lighting, depreciation of equipment or of assets, salaries, all those indirect costs, okay? Those are the examples of indirect costs. So the process of charging them to a product or service is what is called overhead costing, okay? That is what is called overhead costing. So now, when the budgeted overhead is the same thing as actual overhead, it means that the overhead is appropriately absorbed. I repeat again. When budgeted overhead, let me bring it out. When budgeted overhead, okay, budgeted overhead is equal to actual overhead, okay? It means that the overhead is rightly absorbed, is rightly or appropriately absorbed, okay? Let me put it down. So with this, there will be no issue. That will be equal to 0. What you budgeted for is what you incur. So no issue. But in a situation whereby when your budgeted overhead is different from the actual overhead, it may result to either under-absorbed overhead or over-absorbed overhead. So you need to understand what this is all about. So what do you then understand? What do you then understand as under-absorption? What is over-absorption and then under-absorption? Over-absorption. Okay, over-absorption. The over-absorption will arise when the budgeted overhead or budgeted output is greater than the actual overhead or output. Okay, let me put it down. When budgeted overhead or output, let me do it this way. Budgeted overhead or output is greater than actual overhead or output, then this is called over-absorption. This is over-absorption. So if it is over-absorption, what are you supposed to do? You add it. You add it to the cost of goods sold. Okay? If it is over-absorption, you add it to the cost of goods sold. However, when it comes to under-absorption, this arises when the budgeted overhead or output is less than actual overhead or output. When this happens, the difference should be deducted from the cost of goods sold. Let me write it down. Budgeted overhead or output is less than actual overhead or output. So when this happens, it is called under-absorption. If it is under-absorption, what do? You less it. That is why you see in my format, you see that under-absorption is in brackets. Let me show you what I mean by that. You see here that under-absorption is in brackets. So you are expected, whether it is under or over, you are expected to adjust it from the cost of goods sold. That is the treatment of overhead absorption. You can also come in and pick it from there. Under absorbed overhead occurs when budgeted overhead or actual overhead is lower than the actual overhead incurred or actual units produced. In this case, the under absorbed overhead is deducted from the cost of goods sold. That is the interpretation. Then over-absorbed overhead arises when the budgeted overhead or output is higher than the actual overhead incurred or actual units produced. Under this situation, the most important thing to do is to add it to the cost of goods sold, is to add the difference to the cost of goods sold. So that is how to treat overhead absorption. That is how to treat overhead absorption. Please watch out for that. Watch out for that. And this is only relevant using absorption costing method. That is only relevant using absorption costing method. What else do we want to discuss under this? Now that you know what overhead absorption costing is all about, then we need to talk about the reconciliation statement. Excuse me. Yes, we need to talk about reconciliation statement. This is very important. Whether you are asked or not, you are expected to present your reconciliation statement. However, before I go into that, let me know if you have any question for me. Let me know if you have any question for me. Other than that, there's no question. We just proceed straight. Continue. Okay. I want to assume you are okay. Now, in case your fixed production overhead is not, fixed absorption rate is not given to you. If fixed absorption rate is not given to you, then this is the formula for calculating it. It is computed as fixed production overhead over the budgeted output. Remember the other time, I told you that fixed production overhead is computed as budgeted output multiplied by fixed overhead absorption rates. Okay, so you only use this formula. You only use this formula if in the question you are not given fixed production overhead. In fact, in most cases, examiner will not give to you the fixed production overhead. This is the formula that you are going to use to do that. However, if you are given the fixed production overhead and you want to determine fixed overhead absorption rate, from this same formula, all you need to do is to just, you want to make fixed overhead assumption rate the subject of the formula. You want to make this guy the subject of the formula. Then just divide your fixed production overhead with the budgeted output. That's the same thing that you have here. That's how to do it. Okay, so no stress on that. Now let's talk about reconciliation statements. Now, the income statement prepared using marginal and absorption costing concept will never produce the same result. The result will always be different. The net profit or loss under marginal costing will always be different from the net profit or loss under absorption costing, except it is by coincidence or accidental. They will always be different. This is because of the method of valuing stocks. Marginal costing concept value opening and closing stocks using total variable cost per unit, whereas the absorption costing method value stocks at total cost per unit. Therefore, the variance between the results of the two techniques should be reconciled, and the difference in profit before tax, when you are reconciling the difference in the profits, then the difference in the profit before tax must be equal to the difference in stock valuation. Once that is done, that means you are good to go, 100%. You are rest assured that the 15 marks or the 20 marks the examiner will award for you, you got it correctly. Once your reconciliation statement balance, that means you are good to go. Just like when you are preparing your statement of financial position, your balance sheet, and you see that, oh, the assets and the liability, or the net asset equal. So that means you are good to go. All right, you are good to go. Once your balance sheet balance, you say, oh, that means what I've done is correct. Not in all cases, but in this one, once the difference in profit equates the difference in stock valuation, then you are good to go. All what you have done will be correct, is correct. Now, there's a format that you can use to prepare your reconciliation statement. Please note that when you want to prepare your reconciliation statements, you need difference in profits, the difference in profit before tax, not difference in net profit. It has to be difference in profit before tax. Please, it's very important. Note that it is profit before tax, difference in profit before tax, not difference in net profits. Then you also compare that with difference in stock valuation. So you go to the question, to your solution. What is you are going to start from the absorption costing technique. You go to your absorption, the statement that you have prepared using absorption costing. What is the profit before tax? Whatever you have, put it there. Then you now less profit before tax using marginal costing approach. So the difference would then be, of course, that's the difference in profit before tax. You keep it on one side. You now go and determine difference in stock valuation. When you want to determine difference in stock valuation, you need to start from closing stock. So from the closing stock, remember we said that what is causing the major reason for difference in profit between the two techniques is because of the method of valuing stocks. Okay, if that is the case, you go to the question or to your table that you have prepared, or the income statement that you have prepared. So you go and pick closing stock under absorption, put it there. Then you now list closing stock under marginal costing concept. This would be difference in closing stock. Then you now find difference in opening stock as well. You go and pick opening stock under absorption, opening stock under marginal. You less the difference between the two. So that will give you this difference there. So difference in closing stock minus difference in opening stock will give you difference in stock valuation. So at all time, A must be equal to B. That is, difference in profits must be equal to difference in stock valuation. If they are not equal, something is wrong somewhere. You need to go back to your statements, go and check the line item. If you have made a calculator error or whatever the case may be, just go in there, go and change, go and trace the line item and find where the error is coming from. Because at all time, difference in profit must equate difference in stock valuation. So that is as per reconciliation statement. When you do this and the two of them balance, A is equal to B, you should be rest assured out of the 100%, you have earned 15 marks, or you have earned 15% or 20%, depending on the marks allocated for the question. So that is that. That is that. I think I've explained all the underlying concepts in operating statements. So that's that. So at this point, let's have illustration. You can read about the advantages and the disadvantages of each of them. You can read it, okay, on your own, okay? So go through it and read about it. So before I switch to illustration, let me know if you have any question for me. I want to hear from you. Any questions so far? Let me know if you have any question for me. If there's none, then I need to go ahead for solution. Okay. All right, then. So I believe there is no question. You are good with me. So let's move on. Let's move to illustration. I'll be very happy if I can solve. We can't solve more than 2 illustrations on this because it usually takes time. So if I can finish 2 illustrations between now and when the class will end today, then that will be it. That means in our next class, we're moving to relevant costs for decision making. So that's that. Let's move on. Let's have illustration. Let me see. Okay, well, I even have only 2 illustrations set. So let's move on. Yes. I need someone of you to read for us. I've been doing the talking since. I need somebody to read.
I'll read.
Okay, please go ahead. Amen.
Fernandez Company Limited manufactured face towel. The standard unit cost of its production are given below. Direct material, 1.60. Direct labor, 1.50. Variable manufacturing overheads, 1.20. Fixed manufacturing overheads, 3.00. All sums up to 7.30. At normal operating capacity, 200,000 units of products should be manufactured. Variable selling and administrative expenses amount to 50 kobo per unit, and fixed selling and administrative expenses amount to 75,000 naira a year. Income taxes at 40% of net income before taxes. Production and sales data for the year 2008 and 2009 in units. Inventory on hand, January 2008, 28,000. Production for the year 2008, 200,000. Sales for the year 2008, 160,000. Production for the year 2009, 150,000. Sales for the year 2009, 180,000. In both years, each towel is sold for 10.50. Required Prepare income statements for the years by A, absorption costing method, B, variable costing method, C, prepare a reconciliation statement to show why there is difference between the results of the two methods.
Thank you very much, Imam. Yes, that is the question. The requirement is very explicit. You have to prepare income statement using absorption costing method, variable costing method, and also prepare a reconciliation statement. This is a complete question under operating statements. So what are you supposed to do? In this question, you are given two periods, okay? 2008 as well as 2009. Usually, question on marginal and absorption costing is very direct, very simple, but only that it takes time to solve. It takes time, especially when you have more than one period. If an examiner wants to injure students, they can give you 3 periods because you just be wasting time because most students will rush it. But once you rush it, you won't know that time is already going. You think that, oh, this is a bonus, you know, but in any case, move on. How do you then solve this? Examiner says you should use absorption costing method. Let me stop sharing the notes. Please open to the material at your hand so I can switch to the working note. All right. Let me switch to the working notes. I'll stop sharing this. Okay. Share. Let me know if you can see my working notes. Can you see my working notes?
Yes, sir.
Okay, thank you. So, I would then say solution. The name of the company is Fernandez. Fernandez Company Limited. Examiner is asking us to prepare income statements using absorption costing method. So I would then say income statements. Let me increase the size of my pen so that it will be bolder. Okay. Okay. Income statements using absorption costing method. Okay. Now, in this question, we have two periods, 2008 and 2009. So each of the periods, we have two sides, the debit and the credit sides. So I would then say 2008, 2009. Under 2008, we have 2 Naira signs. The same thing under 2009. Our figures are in thousands. This will save time. So the next thing I need to do is to determine the sales value. Remember, we are using absorption costing method. So I want to determine sales value. Let's go back to the question. How do we determine our sales value? To get the sales value, we are expected to multiply the units sold with the selling price per unit. Selling price per unit is 10 naira 50 kobo. In 2008, how many units were sold? Talk to me. Please bring out your calculator and be giving me the number. You have to participate. In 2008, how many units were sold? Yes. Are we still together? You guys are not talking.
We are, sir. But I don't have the material yet.
2008 is 160.
Okay. So
160.
units sold in 2008 is 160. Selling price is 10 naira 50 kobo. Therefore, 160 multiplied by 10.5. 160 multiplied by 10.5. What do you have there?
168.
1680, 1680.
1,600.
So I will then come here. In 2008, the sales value is 1,680,000. Our figures are in thousands. Okay? Our figures are in thousands. So let's do 2008 before we go to 2009. So immediately after sales, we need to determine production cost. So the first item under production cost will then be opening stock. Please mute if you are not talking. If I'm not asking you to talk, please mute. Now, I will then go back to the question. If I have opening stock, we are given inventory on hand January 2008 to be 28,000, isn't it? We have opening stock of 28,000 at the beginning of January 2008. Using absorption costing method, what are you supposed to do? You need to add up all the total cost per unit, then you multiply with 28,000 units. So from the table given to us from the first table given in the question, we are given direct material of 1 naira 60 kobo, 1.6. We are given variable manufacturing overhead we are given direct labor to be 1 naira 50 kobo, okay? 1 naira 50 kobo plus 1.5 plus variable manufacturing overhead of 1 naira 20 kobo, 1.2 plus the fixed manufacturing overhead of 3 naira. Add everything together, that's 7 naira 30 kobo. That 7 naira 30 kobo is your total cost per unit. Remember, using absorption costing approach, the opening stocks are valued at total cost per unit. I would then say 7.3, okay, 7.3 multiplied by 28,000 units. That will give us 404,000 naira. Let me know if you get the same amount. Here is 204.
Yes, sir.
204.4. That's the amount, that's the value of the opening stock. The next item will then be the direct material cost. And direct material per unit is 1.6 naira. So I will say direct material at 1.60. So for me to get the direct material cost, I need to go and pick actual units produced in 2008. In 2008, how many units were produced? Check for me. 2008, how many units were produced?
200.
Thank you. 200,000 units multiplied by 1.6 naira. Yes. 200 multiplied by 1 naira 60 kobo. What do you get?
320.
320. Thank you. Then we'll move to the next one. Go back to the question. If I have direct whether we are given direct labor. Yes, we have direct labor of 1 naira 50 kobo. So 1 naira 50 kobo, 1.5 multiplied by 200,000 units produced. What do you have?
300.
300. Direct labor at 1 naira 50 kobo. That's 300. Next item, I will go back to the same table. I need to go and check if I'm given direct expenses. In this case, we are not given direct expenses, so you ignore anyone you are not given, just ignore it. But the next item we are given is variable manufacturing overhead to be 1 naira 20 kobo. So I will say variable manufacturing overhead at 1 naira 20 kobo. Units produced is 200,000. So 1.2 multiplied by 200,000 is what?
240.
Yes, 240. Remember, we are using absorption costing method. And we said that absorption costing method is a concept that charges the total cost of production to the unit cost of a product. What we have done so far, they are the variable costs. So we need to add fixed production overhead. So I would then say fixed manufacturing overhead at 3 naira. The actual unit produced in 2008 is 200,000. Therefore, 200,000 multiplied by 3 naira will give us
600.
600. 600. So add everything together. What do you get?
1,664.4.
1,664.4. This represents cost of goods available for sales. That is cost of goods available for sales. Now that we have the COGS, the next thing we need to do is to less closing stocks. I would then say closing stocks at total cost. Total cost is 10 naira 50 is 7 naira 30 kobo. Okay. Let's go and do working for that. Remember, I told you the other time that I'm going to explain how to calculate closing stock, but it skipped my mind. However, we can still do it. So the second page will be for absorption. The third page will be for reconciliation. The fourth page will be for workings. So here is our working. Working number 1. We want to determine closing stock. Okay, closing stock for 2008 and then for 2009. When you want to compute your closing stock, we are going to start closing stock is opening stock plus actual unit produced less units sold. Therefore, I would then say opening stock in units. In 2008, opening stock is 28,000 units. In 2008, how many units were produced? What was the actual unit produced? 200,000. 200 in 2008 is 200,000. So you add it together, that would be 228,000. That is the total units available. Total units available. So from this, you are going to make sales. So less units sold. In 2008, how many units were sold? In 2008, how many units were sold?
160,000.
160,000 units were sold. So give me, what's the difference? The difference is
68.
68,000.
So this is the closing stock in units. That's the closing stock in units. So if I want to determine closing stock in 2000, let's do it once and for all. So in 2009, closing stock of 2008 will become opening stock in 2009. Therefore, here will be 68,000. In 2009, what's the actual unit produced?
150,000.
150,000. Here it will be 150,000 plus 68. What do you have?
218,000.
218,000 is the total unit available in 2009. How many units were sold in 2008?
180,000.
180,000 was sold. What's the hiatus difference?
38,000.
38,000 is the closing stock in 2009. So now that we have determined the closing stock in units for both years, the next thing we need to do is to determine the value. So we need to value our closing stock. I would then say valuation. Okay. Valuation. Using under marginal, let's start with absorption first. Absorption, under absorption costing method. In 2008, under absorption costing method, let me do it this way. Under absorption costing method for 2008, okay, closing stock in 2008 is 68,000. And total cost per unit is 7.30, 7.30 kobo. So give it to me. What do you have there?
496,400.
496,400. Okay, that's the total value of the closing stock in 2008 using absorption costing method. In 2009, using absorption costing method, closing stock is 38,000 multiplied by 7.30 kobo. What do you get?
277,400.
277,400. Thank you. Then let's do our workings once and for all. Let's do for marginal costing method. For 2008, closing stock is 68,000 multiplied by 4.30 kobo. You remember, total variable cost per unit is 4.30 kobo. So multiply, what you get?
292,400.
292,400. Okay. Then in 2009, 38,000 units multiplied by 4.30 kobo. Give it to me.
163,400.
163,400. That's it. This is how to calculate closing stocks. Therefore, let's go and put it down. So in 2008, closing stock is 496.4. 496.4. So I would then come here. This is working number 1. 496.4. You less. What's the difference? What do you have as a difference?
1,168.
1168. 1168. Like this, right?
Yes.
Okay, then. So this represents cost of goods sold. Immediately after the cost, remember, we are using absorption costing method. Immediately after the cost of goods sold, you have to account for overhead absorption. So let's go and calculate our overhead absorption. That will take us to working number 2. Working number 2, overhead absorption. Okay. The overhead absorption is all about comparing your budgeted output with the actual output. So in 2008, we also have 2009. Okay. In 2008, we go and pick the budgeted output. Your budgeted output is the same thing as your normal capacity. So we compare with actual units produced, actual production, or actual output. So in 2008, what is the budgeted output? According to the question, what's the budgeted output? Yes. Pardon?
100,000.
100,000.
200,000 is the budgeted output. So I will then come here. Here is in 2008, budgeted output is 200,000 units. In 2008, what's the actual unit produced?
200,000.
The same 200,000. Therefore, the difference between the two is equal to 0 in 2008. Difference is equal to 0. Let's do for 2009 once and for all. In 2009, what's the budgeted output?
200,000 also.
Pardon?
200,000.
200,000. Okay. In 2009, how many units were produced?
150,000.
150,000.
150,000. Okay. The difference is 50,000. That 50,000 is positive, right?
Yes.
Good. Okay, then. Now, remember my explanation earlier today. I said that when budgeted output is greater than actual.
Excuse me, sir. Hello.
Yes. Yes, I'm listening.
Sorry. This at normal operating capacity, so it goes for both 2008 and 2009.
Yes, it's constant. Yeah. Okay. So I told you
Can
earlier
you hear me,
today that.
please?
Pardon?
I didn't get
As I said, it's the same thing.
you. So
Budgeted
the normal operating capacity of 100,000
is the same thing for both years. That's what the examiner gives. Okay. Hello? Do you understand now?
Yes, sir.
Okay, then. So I said that when budgeted output is greater than actual output, it is called over-absorption. So if it is over-absorption, what are you supposed to do? You add it.
Add it to the cost of goods sold.
That is over-absorption. So here you are supposed to add to the cost of goods sold. But if budgeted output is less than actual output, it is called under
Absorption.
If it is under assumption, you less. So in our case, in 2008, it means that the overhead is appropriately absorbed. But in 2009, budgeted output is greater than actual output. That is over absorption. If it is over absorption, then you are supposed to add. So the 50,000 you are seeing there is in units. So we need to determine the value. So in 2009, we have 50,000 units as difference multiplied by fixed overhead absorption rate is 3 naira. according to the question, fixed overhead absorption rate is 3 naira. That is your fixed cost per unit, fixed production overhead per unit. That's 3 naira. So multiply with 50,000. What do you have?
150,000.
150,000. This is over absorption. This is over. In 2008, it is, sorry, 2009, it is over absorption. Okay, so that is that. When we get there, we use 150. But for now, in 2008, we don't have, is 0. So let's move on to the next one. So let's go back to the main page. I would then say, because we've already done our calculation, we know what we want to put there. It is over absorption, over absorption. So we do it later on. In 2008, nothing is there. Okay, so that's nothing minus or plus 1,168. That will be 1,168. So 1,168 minus 1,680. What do you have? Yes.
512.
512. 512,000. This 512,000, what do we call it? This is gross profit. That's gross profit. Remember, immediately after gross profit, what are you supposed to do?
We have to charge tax.
No, not tax.
Production expenses.
You charge, you are going
Non-production.
to non-production cost. You deduct non-production cost. Okay, non-production cost. This non-production cost could be variable or fixed. So you had all of them together. So let's go back to the question to identify the non-production cost. Immediately after the first table, you are told that variable selling and administrative expenses amount to 50 kobo per unit. Are we together? Variable selling and admin expenses, 50 kobo per unit. So let's go and do that. Variable selling and admin at 50 kobo. 50 kobo is 0.5. Variable selling and admin expenses. This will be based on unit sold, not unit produced, because it's a selling expenses. Selling expenses will always be based on unit sold, but not on units produced. Therefore, in 2008, how many units were sold? 160,000 units were sold, isn't it?
160.
So 160,000 multiplied by 50 kobo, that should give us 80,000. That is 80,000. Here will be 80. Please let me know if there's anything that is doing UIY so that I can explain on time before it's too late. Okay, so that is variable selling and admin expenses. Then we also have fixed selling and admin expenses. We are told is 75,000 naira a year. So fixed selling and admin expenses, 75,000 naira a year. So any other expenses? None. Okay, there's no more. So add the two together. That's 155,000. 155,000 minus 512. What do you get?
357.
357,000. Here is 357,000. So this represents profits before tax. This is profit before tax. Then I will go back to the question, if I'm given tax rates. Yes, examiner has given us income tax to be 40%. Therefore, I can say 357,000 multiplied by 40%. So what do you get?
142.80.
142.8. So what's the difference? Yes.
4.20. 14.2.
214.2. This represents net profits. So we are done with 2008. Let's go to 2009. So far, any YY, is there anything that you are not getting? Let me know. Okay. In the absence of none, let's move on. We are done with 2008. Let's move to 2009. In 2009, how many units were sold? Yes. In 2009, 180,000. So 180,000 multiplied by 10 naira 50 kobo. What do you get?
1,090.
1,890. That's the total sales for 2009. So let's determine production cost for 2009. Under the production cost, the first item is opening stock. So closing stock of 2008 will become opening stock in 2009. Therefore, here will be 496.4. In 2009, how many units were produced? 150,000 units were produced. So 150,000 multiplied by 1.6. Multiplied by 1.6. What do you get?
240.
240. 150 multiplied by 3. Oh, sorry, multiplied by 1.5.
225.
225. 150,000 multiplied by 1.2.
180.
180,000. 150,000 multiplied by 3.
450,000.
450,000. That's the fixed manufacturing overhead. You will notice that in 2008, units produced was 200,000, and the fixed manufacturing overhead was 600,000. In 2009, units produced reduced to 150,000, and the fixed manufacturing overhead was 450,000. That is why I said earlier on that the fixed manufacturing or the fixed production overhead will vary depending on the activity level. If the activity level increases, your fixed manufacturing or fixed production overhead will increase. If your activity level reduces, your fixed production overhead will also reduce. So that is that. Then add it up. What do you get? Add the 5 of them. What do you get?
1,591.4.
1,591.4. Okay. Then closing stock. We've already calculated the closing stock in working number 1. How much was it? In 2009, under ACM, 277.4.
Yep.
Here is 277.4 minus 1,591.4. What you get?
1,314.
1,314. Then we need to consider overhead absorption. So we have done our calculation for that. This is working number 2. And we got 150. Because it is over absorption, so we are adding it. So add it up. This will give us what? 1464. This is 1464. So 1464 minus 1890. 1464 minus 1890. What you get?
Minus 426.
426. It's not minus, so it's positive. This is 426. So 426. Then we need to consider non-production cost. In 2008, how many units were sold? We want to determine variable selling and admin in 2009. How many units were sold in 2009? 180,000 units were sold, isn't it?
Yes, 180,000, sir.
So multiply by 50 kobo will give us 90,000. Okay? Then fixed selling and admin expenses remain constant at 75,000. When you add the two together, that's 165,000. 165 minus 426, what you get?
So 26, 261.
261. 261. Okay, that would be 261. So what's 40% of 261? Let me do it this way. Profit before tax. Profit before tax multiplied by 40%. All right. So
104.
104.
pardon?
104.
0.4.
0.4. Okay, so what's the difference? That's
156.6.
156.6. So that's the operating performance of Fernandez Company Limited using absorption costing method. We just finished one part of the.
6, not 0.4.
Pardon?
Hello, sir.
0.6.
Okay,
0.6, not
156.6. Oh, okay. Error of mind. 156.6. Okay. All right, Lua, talk to me.
Yes, sir. I have an issue with the over assumption. I thought you
Okay.
said the difference between the budgeted output and the actual output is
Yep.
the overhead assumption.
Yes.
But for 2009, the
Yep.
budgeted output was 200. The actual output is 150. Then the difference we had was
50.
50,000.
Yes.
Yes. But on the working, we have 150 there.
Yes, that 50,000 is in units. We are talking about the overhead itself. So you need to for you to get the naira amount of it, you need to multiply with fixed overhead absorption rates.
Okay.
So that's
Thank
why
you,
you
sir.
see, you notice that we multiply with 3 naira. See it there. We multiply with 3 naira. So that's what
Yes.
gave us the 150. Yeah, that's it.
Oh, okay. Thank you, sir.
You're welcome. So let's do for 2009. Sorry, using marginal costing approach. So we're done with A. This is A requirements. Let's go to the B requirement of the question. We are to use variable costing method. Variable costing method is the same thing as direct costing or marginal costing method. So let's quickly do that. Number B, income statements using variable. What's wrong with you? Using variable costing method. Okay. 2008, 2009. 2 naira sign. Figures in thousands. Okay, so sales value will remain the same thing. Here is 1680, here is 1890. Then production cost. So you'll be calling the numbers for me, the numbers we had up there. Okay? But first thing first, you need to determine the opening stock. Remember, we are using variable costing method, and we are told that, the principle says that opening stocks are valued at total variable cost per unit using marginal costing approach. So what is total variable cost per unit? Total variable cost per unit in the question is 4 naira 30 kobo. So opening stock is 28,000. 28,000 units multiplied by 4.3. Sorry. 28,000 multiplied by 4.3. That's 120.4. Here is 120.4. Okay. Then we now add direct material. Direct material, what do you have up there? We have done the calculation previously. Under absorption, direct material is 320.
320.
We also have direct labor. How much is direct labor?
300.
300. We have variable manufacturing overhead. Variable manufacturing overhead. How much was it?
240.
240. So you don't include, remember, when you are using marginal costing approach, you are not expected to include fixed manufacturing overhead. Therefore, add up all of this. What do you get? What do you have? Yes. Are you still there? Are you still there?
8.4. Yes, sir.
You have to be fast in giving numbers, otherwise we sleep here. What do you say is the total?
980.4.
980.4. Okay. Then you are going to less closing stock. We have done the working. Closing stock under variable costing method is 292.4. 292.4 in 2008. 292.4. So what's the difference?
688.
688. This 688 is called cost of goods sold. Immediately after cost of goods sold, based on our format, the next thing that we follow is to add variable non-production cost. So you add variable non-production cost. According to the question, what are the variable non-production costs? We have variable selling and admin expenses only. So selling and admin, is it admin or distribution?
Admin.
Admin, right?
Yes, please.
Yes, variable selling and admin. Okay. So, and then we got 80,000 in 2008 because it's 50 kobo. So that's 80,000. Here is 80. There is no other variable expenses again. So add the two together. That will be 6. That will be 768. So 768 minus 1680. What do you get?
912.
912. 912. This 912 is called contribution. So if you have other variable non-production costs, you are going to add it, like variable and distribution, variable selling and distribution, variable admin, any other variable cost that is not related to production, you are going to add it under variable non-production cost. So from the contribution, you are going to less period cost. Under the period cost, you have fixed manufacturing overhead. Remember, I told you that under marginal costing approach, fixed production overhead is based on budgeted output. So if you want to do working on this, I can say working number 3.
FOAR.
Working number 3, fixed manufacturing overhead is equal to the budgeted, budgeted output multiplied by fixed overhead absorption rate. Remember, budgeted output is 200,000 units multiplied by fixed overhead absorption rate is 3 naira. Therefore, here will be 600,000. That's the fixed manufacturing overhead. So I will then come here.
Working 3.
Working number 3. 600,000. I will go back to the question. What are the other fixed costs? We also told in the question that we have fixed selling and admin expenses amounted to 75,000 naira. Fixed selling and admin, 75,000. Add the two together, that's 675,000. Minus 912, what do you get?
237.
This is 237. This 237 is called profits before tax. So you are going to less income tax of 40%. So what's 40% of 237?
94.8.
94.8 minus 237.
142.2.
142.2. This represents the net profit in 2008. So move to 2009 under marginal costing approach. Closing stock in 2008 of 292 will become opening stock in 2009. Okay, so from our calculation under absorption costing method, what is direct material cost in 2009?
240.
240. Direct labor cost, 2009.
225.
225. Variable manufacturing overhead, 2009. Sorry, 2009, yes.
180.
180,000. So add up everything. What you get?
937.4.
937.4. Okay. Then closing stock in 2009, we have done working for that. Under marginal costing approach, closing stock 2009, 163.4. Here is 163.4. Minus that, what you get?
774.
774. Okay. 774. All right. So we need to add variable non-production cost. Selling and admin expenses in 2009 was 90,000. That is 50 kobo multiplied by the units produced, units sold in 2009. And 2009 units sold was 180 multiplied by 50 kobo. That's 90 naira. Add it up. What you get? That is 864. Please, as we are doing this, I would love it if other person can be checking the accuracy of the numbers. so that we don't go too far before we realize there's an error. Okay, so 864 minus 1890, what you get?
1026.
1026. Thank you. So 1026 period cost. In 2009, the fixed manufacturing overhead will remain the same as 600,000. It will not change until, because it is based on budgeted output. Then fixed selling and admin expenses is still the same thing as 6075. So 1026 minus 675. What do you have?
351.
351. 40% of 351.
140.4.
140.4. What's the difference?
210.6.
210.6. That's it. When you look at the net profits under variable costing method for 2008 and 2009, and then the net profits under absorption costing method for the same period, you will notice that they are different. So what is causing the difference? And that is why the examiner is asking you in the C part of the question that you should prepare a reconciliation statement. So let's prepare the reconciliation statement, and that will be the end of the class for today. So number C, reconciliation statements. (2008), 2009. So double naira sign. So the first item will be profit before tax. Profits before tax. Under absorption costing method, under marginal costing method. So what is profit before tax in 2008 under absorption costing method? Profit before tax.
357.
357, then 261. 357. Here is 357. Then 261. Is it 261 or 251? Yes, 261. Then under variable costing method, profit before tax, 237, 351. Here is 237, 351. So less, less. So what do you have? Give it to me. What's the difference?
120 for the first one.
And minus 90 for the
Here
second
is
one.
120. Here is minus 90. Okay, then. So that's it. This is difference in profits. Then we now move to, this is number A. We move to difference in stock valuation. So I would then say stock valuation. Under the stock valuation, we first of all find difference in closing stock. Under ACM, and then under variable costing method. Please don't go and make mistake and be using marginal. Examiners say variable costing. So we have to be consistent. Hope I've not used marginal up there. Let me go and check. It's variable costing. Okay, then move on. We're almost there. Now, for the difference in closing stock under ACM is 496.4 in 2008. Closing stock is 496.4. Let me confirm. Under Yeah, 496.4. Then under VCM, variable costing method, closing stock is 292.4.
Yes.
Here is 292.4. So what's the difference?
204.
204. Then we need to find difference in opening stock. So opening stock for ACM and then VCM. Opening stock for ACM in 2008 was a
204.4.
204.4. Okay. Then for VCM, it is 120.4. Here is 204.4, 120.4. What's the difference?
84.
84,000 is the difference. Therefore, 84,000 minus 204. What do you get? 120,000. Okay, this is difference in stock valuation, which is B. Here is B. Then let's go to 2009. You will notice that in 2008, difference in profit is 120,000. Difference in stock valuation is also 120,000. That means in 2008, what we have done is perfectly okay. Let's move to 2009. In 2009, what is the closing stock? In 2009, under ACM, what's closing stock?
277.4.
277.4. 277.4. Under VCM, what is closing stock?
163.4.
163.4. So give me the difference.
114.
114. Then opening stock in 2009 under ACM. What is opening stock? That should be 496.4, right?
Yes.
Then under VCM, opening stock in 2009 will also be 292.4. So what's the difference? 204. 204. Therefore, 114 minus 204, what do you have there?
Minus 90.
Pardon?
Minus 9.
Minus 90.
Minus 90.
Okay, minus 90. When you look at difference in profits in 2009 of minus 90, then it's the same thing as difference in stock valuation of minus 90 in 2009, which means what we have done is perfectly okay. So that is the question. That's end of the question. Nothing more to be done in the question. We are done. Okay? So this is how to prepare income statement using marginal and assumption costing. We have one more illustration, but not today. We are going to treat it in our next class by the grace of God. So let me know if you have any question for me before we close the day.
Yes, I have a question.
Talk to me,
Is it
Imam.
do the workings first before you start the calculation for the absorption methods? For the
Is
methods
it,
first.
you are asking whether it is appropriate to do working first before the
Yes,
main
sir.
solution?
Yes,
Now,
please.
the best approach is that your main solution must come first before workings. Working is not what the examiner asks you to do. So what that thing that examiner asks you to do should come first.
Okay.
Secondary. And you have to
All right.
show you're working at all times. All right? Yeah.
Okay.
Yes.
Hello, sir.
Yes, talk to me,
Yes,
Grace.
sir. I was carried away under VCM where you said add variable non-production costs. was carried away when you were calculating the selling and admin expenses. Sorry.
I didn't get that. Take it again.
Selling and admin expenses under VCM.
Yes.
Yes. So how do we get the 80 and 90, please?
Yes. You know, when you talk about selling and admin expenses will vary depending on the number of units sold. In 2008, 160,000 units were sold. Okay, so variable selling and admin expenses were given as 50 kobo. Therefore, 0.5 multiplied by 160 will give us 80,000. That's how we arrive at that 80,000. In 2009, 180,000 units were sold. So 50 kobo multiplied by 180,000 units will give us 90,000 naira. That's how we arrive at the number. Do you get now?
Yes, sir. Thank you very much.
You are welcome. Yes, any other question so that we can close the class?
Yes, sir, can I have a copy of this service?
Certainly, I will share with you.
All right, thanks.
You are welcome. Yes, in the absence of no further question, I want to say thank you to all of you that joined the class. By the grace of God, I will be meeting with you next week again. However, Mr. Ashwaju will be having you tomorrow evening by the grace of God. Good night, everyone. Bye-bye.
Good night, sir. Thank you very